Welcome back to the Behind the Well Show. Your host, Roger Abel, here with Elias Randall again. Elias, looking forward to the show today. Fun time of year for me as a football fan. You know, where I'm a beloved Hawkeye fan, and we kicked the season off with 492 yards of total offense, and I was really giddy during the game, and it looks like maybe we have an offense that's for real this year.
Maybe. You never know.
We'll find out.
That's a good, that's for the fans and the team to worry about, and hopefully they can play good and string some stuff together, score some points. Scoring points helps you win games.
Offensive points.
Yes.
Not just defensive points.
Yes, correct. And the Cy-Hawk trophies this weekend, right? Iowa State.
Yep.
I guess last weekend when this airs, but big weekend.
Yeah, I don't go to many games, but I am going to go down to the game for the Iowa State game, hang out with some of our friends at First Trust Investments, and go to their tailgate and have a fun time.
That does sound fun.
Yeah, I really, one thing I like about them is always have really good kind of research and different stuff. And one of the things, I got a question from somebody the other day, and I don't know, Elias, if you ever get this question, but people just really like to compare themselves to other people. Like I got a email from someone the other day and said, what do most people have when they're 50? Like, how much money do most people have? Am I on track? Do you think I'm doing good? And, I kind of always just preface that question that it's a function of what you're going to spend. Like, how much you have is relevant to your own situation. I know everybody wants to make sure they're doing the right thing, and I think that it's one of the reasons we've talked so long about generating financial plans and getting your unique number of how much you need to be saving, how much you can spend, what your risk capacity is, all those numbers. Do you get that question a lot from your friends? Or maybe it's just me because, my friend group is approaching, most of them are almost all of them are north of 40. Most are 45 to 50. And I feel like when you hit 45, people really start thinking about, hey, I don't have that much longer to work. A lot of people have, been in the workforce for 20 years and they're going, man, that went fast, and I got 20 years left till I actually hit 65. Like, how am I doing?
Yeah, and hopefully I don't have to work until I'm 87 years old, right? People start to wonder and think about that. I would say in my peer group, that question does not get brought up. I think, which I'm 35. So a lot of times people ask more questions along the lines of, what should I be doing? Like, what are the things I should be doing? Which is probably a much easier question to answer than, like, how much is enough for me to retire someday. That takes more. That's a little bit harder to figure out. But definitely prospective clients that are in the age range you're talking about, 45 to 55, they'll be curious on whether they're doing good. Sometimes ask, like, what do most people have? But I think once you start to educate them on, what you have is not really that relevant compared to what other people have if you're on track for what you need to accomplish. And if you, one thing I say to a lot of people is if you're a family that spends $10,000 a month, you're going to need X. Well, if you're a family that spends $500,000 per year, you're going to need significantly more, right? So what you're going to need is just really more depend on your spending and your lifestyle. And I think some of the most successful people that I know and some of our top clients and best younger clients and younger savers, I don't think they're too concerned with what other people have and what other people do. I think they're more concerned with what they should be doing to be on the track that they want to be on. And that's a good place to be.
Yeah, I think I was watching a Dave Ramsey clip the other day, and he actually made a comment. He said, if you're 45 and you don't have $1 million by the time you retire, it's your fault.
If you're 45?
If you're 45 and you're watching this podcast, if you don't have $1 million by the time you retire, it's your fault.
Yeah, 45 is still enough time. Even if at zero, they're saying even if you have nothing today.
Yeah.
Yeah. You can do it over 20
years, 22 years. Like it's enough time. And I think, I also think like at 35, a lot of people are just starting a family. Hopefully they're doing their 401k, getting the match, so at least some of the easy stuff that's out there. But I also think it's like the first time of some real money. You're getting the taste of it. And people, when they get a taste of it, they like to increase their lifestyle and they don't think about, what do I really need to be doing? And part of what jogged my memory with this is I read the Wall Street Journal quite a bit, especially their articles. And there was one out there just saying how to plan for retirement if you're behind in savings. And I thought it'd be good, if you're 45 years old and you're not on track to have $1 million, what are the steps that we would actually talk to somebody about on how to get there? What's step one in your world? Like, what would you tell someone right away? You're 45, you have nothing. How are we getting to $1 million over the next 20 or 22 years?
Save more money.
Okay,
That's
save
the
more.
first step.
Here's problem. That is the first step, saving more. How much more?
You got to figure out what you can do.
Can do and need to do.
Yes, what you can do today and what you should be doing.
Yeah,
and then figure out how to get, over time, get those things along.
Financial plan time, right? That's the way to figure out.
Yeah.
It's really the way. So first step is...
financial plan is a lot more complicated than just saying you need to save more money. I thought it was like...
Yeah, but you know what? Truth be told, let me ask you a question. How complicated is a financial plan if you have nothing?
Oh, easy.
It's not. It's input.
Yeah.
Input A. Okay, this is when I want to retire. I have zero. This is how much I need to spend when I retire. Software is just going to back into a number. It's going to be relatively simple to figure out. So I think that's step one, is figuring out what your number is. And if the later you wait, you can't just throw a blanket advice number at it like, oh, you save 10 or 15%. You got to figure it out. If you do 15% from the time you're like 22, 23, 25, 30, probably works out. I don't know if that works out if you're 45.
Yeah, it depends on salary, right?
Yeah.
I mean, if your salary's high enough, it could. But I think at 45 with nothing, I'm guessing the math would suggest like maxing a 401k is going to have to be a target. Right. Or maybe even max a Roth and a 401k. Like if you can, if you're not above the income limits on a Roth. I think that's probably what it's going to boil down to.
So the step one is figure out what you need to save. Step two is a little about what you just said. How much can you save? Because most people, if we have the discussion that, Mr. Client, you're saving zero today, but you need to get to $4,000 a month. It's not realistic they can do that, because if they could, they would.
They'd already be doing it.
Right, they'd already be doing it. So we then need to figure out, hey, what is the amount we can save? Is it 6% of our checks we can get the free money or the match from our employer? And start employing some of the things we talk about on how we increase the amount of money that people save over time, which the easiest way to increase your savings rate is every time you get a raise, increase how much you save. So let me just throw a scenario out there. We have a family that needs to start saving $3,000 a month. They can do $1,200.
Good start.
Okay, good start. Like, that's a win. Raise time goes around. What do they need to do with the raise?
Increase their savings.
By how much?
Well, if they can do all of it, they should do all of it at that point.
That's the answer. If they're behind, it's all of it.
Yeah.
It's not, hey, I got a 3% raise, so I increase my contribution 1. Like, you just don't get to increase your lifestyle till you get on track. And pretty soon, you'll get to where you need to go.
Yeah, I like that. I mean, that is true. That's the reality of the situation.
So I just thought, if you're behind, step 1 is plan. Step 2, figure out how much you need to save. Step 3 is start saving and execute this plan, and you can be a millionaire. And I thought that the advice that Dave Ramsey gave was actually really good. Like, if you don't have $1 million and you're 45 years old right now, it's your fault. It's not because you didn't get a job. It's your fault.
That's pretty harsh.
Well, I don't know.
It's the reality, though.
Well,
it is. It's the reality.
If you're aware of it, then you just got to fix the problem. Like, saving up $1 million over, because you don't have to retire at 60 or 65. You can work till you're 70.
Not me. That's a
I don't know.
long time.
I mean, yeah, you know what the reality is though, Elias, is people live longer. They're likely going to have to work a little longer. I mean, just think of life expectancy is 60 or 85, and in 20 years it becomes 95. That money's going to have to last longer, which goes into a whole nother conversation of how much you can withdraw and all those different things, which is probably for a different episode. But saving up $1 million over 20 years, yeah, it takes some effort. It's not as hard as you think, though.
Right. Well, and there's actually, so one of the articles I had prepped for this, so 7 in 10 Americans between age 50 and 60, they're considering delaying retirement over 4 major things. And it's in line with what we're talking about, and like not having enough money for retirement, which if you're at this age and you feel like you don't have enough, I think that's where we can make the argument. It's probably time for a financial plan, figure out what you need to do. And one that I think was really, I think this is just more a product of the times, but the impact of inflation has people thinking they will need to delay retirement. And one thing that I was thinking about was that's maybe true, but unless you increase, see, the thing with inflation only impacts certain parts of your life, right? When we had 9% or 10, almost 10% inflation, that doesn't mean your mortgage went up 9 or 10%. Like you have fixed costs. We all have fixed costs. It is what it is, unless you refinance or do something.
Right.
But it's really only your like discretionary items and your food and things like that that are subject to inflation. So I don't know that a year or two of really high inflation is going to be the difference in someone retiring or not. Like that's almost like the ball's on the 2-yard line and, oh man, we had 9% inflation. Now I can't retire. I don't know how realistic that is.
One of the things I just pulled up, feverishly working, how much you have to save to get to $1 million if you start at zero.
What is it?
$1,900 a month. That's 7%.
That's over 20 years.
That's over 20 years, and that's only at 7%. The markets have averaged better than that. So realistically, like, people can get there. $1,900. Think about this: if you're making $150 as a household, you contribute 10%. You get a 5% match. You're there. That's assuming you only make 7%. 7% over 20 years would be relative to what markets have done, would be a pretty low 20-year return.
Especially in a tax-deferred account.
Right. So
or a tax-free account if you're doing Roth.
You got it.
Yeah.
So I wasn't trying to ignore you. I was just trying to look this up because I knew I had a good number there.
All good. All good. That was good. That was valuable information. And one other thing I wanted to address with the delaying retirement because of being worried about certain things. There's people that are worried about recession or stock market downturn. And I think one thing, all people transitioning into retirement, even if you are 70, right? And a lot of people retire before 70. There will be another recession and another stock market downturn in your life, probably multiple. So that's also to me, that's not a reason. I mean, maybe that is a reason. Like if you end up not working for like 2 years, you're going to work for 2 more years and then retire, but then that didn't work out because of a recession. But I think those things, delaying an event like retirement because of, potential inflation or recession or stock market downturn, those are just things that, one, they're not controllable. And two, if you've done financial planning and you've quantified like the optimal outcome for you, I think you should be prepared for those things.
I think you can
and
plan them away.
You can be prepared.
You can plan them away. Use our bucket strategy.
Yeah.
If you're a year away, this is where that premier bucket strategy becomes, really important. And someone asked me, how much cash do you need to survive a volatile market?
Well, you want to know my answer?
Well, I know your answer because it's my answer.
Okay,
but
yeah.
someone asked me the question because, they hear you need to have an emergency fund of X amount. And I had the discussion. I said, well, that emergency fund isn't to survive a volatile market. That emergency fund is for an emergency, not for your retirement plan. They're two separate things. But realistically, here's how much money or cash you need to survive a volatile market. It's 1 to 3 years of cash. And it's not because we just want to have a whole bunch of cash because it's safe. There's actually math behind it. I went and pulled up this flyer before we did this video, and it's called The Market Declines: A History of Recoveries, put out by MFS. Okay. The average bear market recovery, so market goes down 20%, the average time it takes to get back is 289 days. So most of the time, if you have 1 year's worth of cash, you have enough cash to wait out any market decline on average. The problem with averages is COVID was 1 month. Some are 20 months. This is the reason we lean towards 3 years. The longest bear market recovery, and we're going back to 1929, Great Depression, was 33 months. So just a little over 900 days. So what we're really telling people is, hey, if you have 1 year of cash built up in this bucket strategy, most of the time, you'll never have to sell a stock market investment when it's down. And that's really the concern of an individual when they retire is, I retired and I got unlucky. We've all seen the sequence of return charts where, if one person retires in this year and one person retires 2 years later, they both average the same amount of money. One's out, one has doubled it because one got unlucky. In that scenario, they're assuming that person sells an investment when the stock market's down. It's the number one way to combat market volatility in retirement is just have some cash. And it's easier to have cash today. And what is cash, right? It's stuff that's liquid and safe. Could be bank CDs, could be short-term, debt securities, just stuff that's safe and liquid that doesn't have any volatility on it. That's the really easy. That's why we use 1 to 3 years. We did a radio show, what was it, a week or two ago? Were you on? And I told the listeners, I said, I'm not going to tell you why we have 1 to 3 years. I said, if you want to know, you're going to have to call in. I kind of teased it a little bit, but we gave our listeners today the reason. There's real math behind it. It's not just pulling this stuff out of thin air. We've studied this. We get research on this, and we build strategies to help people overcome their fears in retirement.
And that example, the Great Depression, doesn't seem like a long time ago.
It's 100 years ago.
But really, in the big picture, that's not that long ago. Like sometimes I wish we had 1,000 years of capital market data.
There probably is. It's just very archaic capital market data. How long's the stock market been around? I don't even know. We should know this. Let's Google it. The first stock market began in 1611 in Amsterdam. The U.S. didn't get into the stock game until 1700. So we have 320 years of data. I'm just guessing that a lot of those years weren't kept, and the things change as the Industrial Revolution and all these other things happen in America.
I guess I'm thinking more like post-Industrial Revolution type data, right? Because I understand that longest bear market recovery was basically 3 years. Just the way companies are now and how our economy runs now, it's hard to picture something like it's hard to picture a Great Depression and something the stock market's been down for 3 years. We're in economic slowdown. It's just hard. For me, it's hard to picture those times because now companies want to run much better. They're more efficient, better technology. But anyway, and it seems like, man, that's so long ago, and companies were ran so much different. But I think the one thing to keep in mind where I was going with this, like the behavior of it, the stuff we do gain from that, and I think this is one of the most true things in finance. Like people's behavior don't change over time, and really kind of as you make decisions, you kind of swing through different emotions. Sometimes you're greedy, sometimes you're more fearful. But like those like behavioral things over time just to me don't really change.
No, and ironically, people think that I feel like when there's a bear market, people think it lasts forever. They really don't.
Well, recently when we had a couple bad selling days and the market went down 3 weeks later, I had people asking me like, how are things going? There was 2 days of sensational news and people thought it went on for a month.
August was positive, had a positive return for the year. But the first 2 days it was down,
and 2 terrible days in there.
Yeah, I'm just looking at this chart. 2022, we saw the last kind of what we would call bear market. Well, it took 9 months to recover. COVID took 1 month to recover. The global financial crisis, which people actually think, they thought it went on forever, right? They felt the ramifications of that in their life, their employment, their house values. It only took the stock market 17 months to actually recover.
Right, because investors didn't believe that this was going to be a permanent situation. They kept buying securities.
So thus the reason that we have our clients try to get that 1 to 3 years of cash so we just don't have to worry about this stuff. And when the market has volatility, we know why they have a growth investment. They know it's 6+ years down the road, but they also have the calm feeling, hey, we have this cash so that we can survive or weather most of the storms that are out there.
And it's helpful. It's helpful when you can do that.
Elias, one of the things that, we talked earlier about, hey, if you're 45 and you don't get to $1 million by the time you retire, it's kind of your fault. One of the things along the way is if you get to that $1 million, we want to try to avoid making mistakes along the way. And one of the things that I see people do is they make mistakes with 401k rollovers along the way that actually cost them. What are some of the biggest mistakes that you see people making with their 401k rollovers, and how do we avoid it? And I know going to a professional is the easiest way to avoid it, but what are the number one mistakes people actually make once they've got to where they need to go?
So a lot of the common things, I think one, just using the 401k as a big piggy bank, rating your 401k for funds because you think you need it instead of keeping it invested and doing a rollover into an IRA and continuing to invest. That's probably that is going to set people back, right? Because let's say you've already done a lot of good saving and you have over $100,000 in your 401k and you cash it out and then start over at zero. It's going to take you, by the time you can get back to the over $100,000 balance, if you continued saving, you're probably close to $1 million by then. So I think rating the 401k, also a common one, just losing track. The other day I was looking, someone brought in all their statements, right? They're going through the full process. So they're tracking down all the old 401ks and accounts that they have out there. And one of them has a decent amount of money in it, and the return over the last 12 months was less than 2%. So they asked me, is that good? I said, well, compared to what the market's done, no. Well, how come it's not doing good? I said, the only thing I can tell from this, because it didn't give me a ticker, it didn't give me the investment.
Right.
It must either just be in a cash sweep account, right? It's maybe not even invested. Or maybe it's in a really conservative account and just hasn't quite recovered yet. But I know if it's less than 2%, has not been invested into a good diversified portfolio of stocks.
Well, and I see the opposite of that too. I see people that think they're really conservative and they own a 2025 target date fund and they think they're conservative. Conservative is subjective, but that's a 50% stock, 50% bond fund. When you tell most people, hey, if the stock market goes down 30%, this could go down 15% because they have 50% exposure to equity markets. They don't view that as conservative.
They don't, probably after they understand it.
Right. They think, oh, I'm
But to the person running that 2025 fund, that probably is a conservative allocation.
Think about this, Elias. How many people think, oh, once I retire, I can't take any risk? That's conservative to them. So by default, don't they look at that 2025 fund and be like, oh, I'm retired. That must be safe.
I think that's the default thing people think.
Yeah.
Yes.
And I think, you know what? I do think it's relatively safe over 10 years, but I don't feel like most people view retirement. They should view it that way, but they don't. They view retirement as, oh boy, I'm retired. My money can't go down ever.
Well, right, which is also the argument for the bucket strategy.
100%.
Because you can still have growth investments, and really you need them. You're going to need growth investments to raise cash 10, 15, 20 years down the road. Another opportunity that people mistake you could say that people make with old 401ks, when they do a rollover, they roll over into something that they don't really understand, right? It could be they roll over into some annuity that someone pitched them, but they don't really understand how it works or what it costs. It could be they roll money over into a commissionable account, but they want to have a fiduciary style relationship with the firm they're working with. So I think, one, just understanding where is this going, right? First of all, the right type of account, and then also understanding how is this going to work for me? How am I paying for the services, and what is my strategy going to be? I think understanding the outcome of a rollover is a common mistake that people make. And with that, the other thing with that, not understanding, one, the rollover and the process and what you're going to do, I thought this was a really good one. Improperly rolling over after-tax funds. So a lot of companies will allow you to put money into the 401k above the 401k limit, but it goes into an after-tax account. Typically, the most common thing I've seen when you do a rollover, your growth is tax deferred, so it qualifies for your IRA, but the money you put in needs to be returned to you because you've paid tax on that. So it's kind of an interesting nuance, but that is something that some plans allow and is out there. I know we have several employers in town that do that. So I think also understanding the different types of funds you could have in there and where they need to go.
Well, some people would say, well, why would I do an after-tax contribution? Right?
Well, you already hit, you're doing the max, so that's your next option if you want to do it.
And the cool thing is if you're doing the max and it's going to a Roth, you could convert that after-tax contribution to a Roth.
Yeah, well, I think that's plan. Yeah,
it's plan specific.
It's plan specific. Some plans will let you send that to your Roth. Other plans return it to the client as cost basis.
But you could roll it over. You could convert it to a Roth, or you could roll it into an IRA and then convert it to a Roth as well.
Yes, you could.
But that's a good one. Like, people need to understand what they're doing in their plan, and a lot of people don't even know why they have that.
Have the after tax?
Yeah, they don't even know why it's there. They don't realize they over contribute. Which, hey, good for them. They put as much as they could.
That's probably
into this plan plus some.
That's probably a beneficial mistake. I was saving too much and I didn't realize.
Well, a lot of people don't realize that you can get up to $66,000 into a retirement plan, including your contributions, employer contributions, and after-tax contributions. Now, not all plans allow you to do that. But there's higher limits than people think are out there based upon just the normal 401k contribution limits for an employee.
Yeah. And did you tell me the other day, did you have someone come in because they have an old 401k and the reason they wanted to meet was they don't want to start doing the required distributions from it themselves or something like that? Yeah,
that's reason one. But reason two, they don't want to be forced to withhold the 20% federal withholding.
Okay. So that's...
Yeah, their income's like $42,000 a year. They're like, why would I do an RMD and then have to send the government 20% when that's not my tax rate?
But that's how they process a required distribution from a 401k.
Well, yeah, any distribution from a 401k has 20% mandatory federal withholding.
Yeah.
That's why they came here. And they came in because they don't want to mess it up. They're really nervous about it.
Right. And that's another thing with the 401k, the old 401ks and the rollovers. And sometimes I think I have run into situations where people think the required minimum distributions are only on individual retirement accounts. If you're not working, they also are on your 401k plan.
Yeah.
So leaving it there is not a way to system skirt required distributions.
So one of the cool things I actually did, they were in earlier today, actually, that we talked about. And this is where, we run that 3-appointment process with people. So we really start to understand what's important to them. And they have pensions. They don't need the money. And I asked them, I said, do you have charitable inclination? Do you donate to charities? They're like, yeah, we do $250 a month to the church. We do $150 to this place. And I said, well, one of the benefits of getting this rolled over is that you can send this money directly through a qualified charitable distribution form directly to the charity and doesn't get added to your income. And they go, yeah, but we do the long form. I said, well, I'm looking at your tax return. You guys don't itemize. You're using the standard deduction. I said, right now, if you take this distribution instead of just sending it directly, you're going to add about $8,000 of income to your situation. You pay tax on $8,000 income. Arguably, it's a low rate. I said, but why would you want to pay anything? And just that alone, that little strategy, they're like, well, that's great because we basically send this whole thing away and not write the monthly checks to the bank or to the churches and the other stuff that we do.
Well, and in that specific situation, you can save money on tax and you're going to donate more money.
Well, they are already donating. So
yeah, you're already doing it, but now the charity's going to get more.
Yeah.
And you want to give money to them anyway.
Yep. So it was kind of a great strategy. They were really happy they did it, but I appreciate you asking that question. And that is one of the mistakes people do. They think, well, if I have a 401k, there's no required distribution. That actually makes it more complicated because if an individual had 5 individual retirement accounts, they could take the required distribution from one IRA. If you have a 401k,
yes,
I take one from the 401k and one from the IRA. It's not, you can't commingle that. Same with the 403b. And it's where it goes to the later you get in life, simplification is better. I had a call with a gal yesterday. She had 3 IRAs. I said, do you think it makes sense at this point in your life to get to one IRA?
Probably.
Net benefit to her was less fees, more organization. There was nothing negative. She goes, is there anything negative? I'm like, no, you don't have 3 anymore. You have 1.
If you view simplification as negative, then yes, it's negative.
That's true.
Sorry. I cut you off.
No, that was a good one, actually. You can cut me off.
Yeah. So then I think kind of to wrap up the 401k mistakes, other thing I want to point out for the listeners, a mistake with a 401k rollover is not something that can be fixed. You do it and it's done wrong. There's really no path to correct the mistake that was made. Then you just have to live with it.
There's 2 things. If you're doing this yourself, you need to do when you do a rollover.
You need to, what are you going to say? Take notes of who you...
Yeah.
Yeah.
1, who are you talking to? What their extension is, what day and what time that call happened. So in all my years, we've had one 401k that got messed up and it was not our fault. So I'll never forget this because I was working with Casey and the client's like, we just got, this 1099 for like $90,000 in this rollover. I'm like, that's not possible. Well, you have all the notes. So we call the company. They're like, well, it takes 7 to 10 days. I'm like, how does it take 7 to 10 days? Like, we have to go listen for all the recording. I'm like, oh no, I have the date, who I talked to, and the exact time. They went back and reviewed it, what had happened, the processor in the other line. There was a drop down tab and they scrolled and it scrolled from rollover to Roth IRA conversion. And I told them, I'm like, how could the client convert it without signing some forms? And they corrected it and got it fixed. Had we not had who we talked to, the confirmation number, the date, and the exact time that call started, that likely could have been a bigger mess for our clients and definitely would have taken longer than 24 hours, which we got it done in. So that's the number one takeaway. If you're doing this yourself,
even got resolved because they probably would have come back and said, "Yeah, we went through all the recordings, can't find nothing."
Right?
Yeah, because you didn't look.
So it goes back to if you're doing a call and doing this yourself, document it. So if something goes awry, you have a way to go figure it out.
Well, and you know how it's almost every single you've done thousands of rollovers too. People are always so thankful when you do that phone call with them. It's like one of the most, I think, valuable and beneficial things. I've had so many people when that phone call is over go, I'm really glad that you did that for me. Because they hear the questions and I'm asking and they're, oh, I would have never asked that. I don't expect you to know what to ask. You're not a professional in this business. But the reason I'm asking those is because I know it's recorded, so I need to ask all the right questions, and then I need to know all the things we talked about.
Well, and think about it. What we're doing is we're assuming it's not going to get processed correctly. So if we assume it's not getting processed correctly, we ask the questions to make sure we know how to fix it.
And if it's not, and if it was done wrong and I don't have notes, whose fault is it going to be?
It's
the
ours.
Client's going to make it, it's going to be my fault. Whether I did it wrong or not, like in the client's mind, it's going to be my fault because I didn't handle the situation properly.
Well,
which is fair. That's what they should think.
It's why they have us. And in 22 years, I've only had one ever messed up. It wasn't us, it was them, and we got it fixed. So it was pretty easy for the client. But with that said, if anybody's looking for help with a financial plan, looking to get started, looking for help with the rollover, give us a call or just, hit the link in the description. You can find us on X, Facebook, LinkedIn. I think we're on Instagram now. With that said, I want to thank everybody for listening. I hope you keep tuning in.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. Prior to investing in a 529 plan, investors should consider whether the investor's or designated beneficiary's home state offers any state tax or other state benefits such as financial aid, scholarship funds, and protection from creditors that are only available for investments in such states' qualified tuition programs. Withdrawals used for qualified expenses are federally tax-free. Tax treatment at the state level may vary. Please consult with your tax advisor before investing.